Everybody, hopefully you can hear me. Am I coming through to everybody out there? Awesome. Thank you for that. Brilliant. Okay, right guys, let me just pull the presentation up and then we'll get going. Oh, we've got a few things to get through today, so we are going to scoot through. So bear with me, everybody. For those of you who don't understand or you missed something that I said, there's always the recording. And on top of that, obviously, just stick something in the chat if you'd like me to explain in more detail. So here's the thing, guys. Right, number one. Key thematic. Well, obviously, let's go through the disclaimer first, right? So, as always, educational show. Anything you do at your own risk. I can't be responsible for any trades that you take. I think you guys all know this as well too now. So, purely as I say, this is an educational show. So here we are, just to try and hopefully get you a little better. And this is really about, as always, developing your edge. So, sentiment cycle. Okay. This is super important, okay? For those of you who have seen this before, for those of you who are going to be in Singapore in 2 weeks' time, you maybe hear me talking about this. I'm going to cover the sentiment cycle because, as always, it's so important. We're at one of those key stages right now where things are starting to happen. You've got to look at this to try and figure out and understand what is going on. Okay, so the sentiment cycle for me is the overall thematic of the market. Okay, are we going up? Are we going down? Are we trending up? Are we trending down? Are we boring at the bottom? And so everybody is bored of trading stocks, bored of trading foreign exchange, volatility is low. Similarly, at the same time, on the other side, are we bored at the top? Volatility is low, stocks are going up, assets are going up, foreign exchange has stopped trending and it stalls out in one particular direction. There's nothing happening. Okay, yes, and then we get a breakout to the upside and it fails. Okay, then we get interesting. Okay, so let's look at today with this lens on what is going on in the markets. So we're going to look through the Super 7. As always, to explain this, I try and go through this really quickly. Okay, we have two currencies in there. Why do we have two currencies? Two currencies because the euro US dollar and the Dolly Yen covers all three major economic zones in the world. No matter how we try and cut this, it really does matter, and the three zones are really important. We need to look at some commodities right now. Why? Well, because we've got allegedly runaway inflation, and as a result of that, it would seem realistic to look at commodities, especially oil and especially gold, the old favorites. I don't need to give you the reasons why we need to look at gold. And oil is, again, for exactly the same reason. It is the poster child of the commodity markets. As oil goes, so do go a lot of other commodities. We're going to look at the S&P 500, and we're going to look at, as always, at the most important market of the lot, which is the long-term US interest rates. So these decide many, many, many markets around the world in terms of direction and also in terms of strength. And then finally, as always, and I stick it on the bottom because it's not quite mainstream just yet, despite what people say, we're going to be looking at some cryptocurrencies, and I always like to look at Ether or Ethereum because it's for me it's the most liquid one, and at the moment it's also clearly quite a big topic given what's been going on this week with some of the tethers as well too to the stable coin market, which essentially has been in complete turmoil and chaos for the last 2 weeks. So look, the key theme I've got to all of this, and I don't think there's any particular secret about this, is something is happening to the US dollar. I won't put a dollar index chart up here. You guys know that chart inside out, right? So I don't need to put it up. Suffice to say that the dollar is trending and has been trending for quite some time. In fact, when you look at some of the markets, some of the foreign exchange markets, you can see just how long the dollar has been trending for. So why is the dollar going up? You can come up with all sorts of reasons about interest rates and this and that, but there's always been a reasonable interest rate spread to US dollars over the course of the last 18 months to 2 years. Is that really the difference? To me, it isn't. To me, there's just a significant shortage of dollars. Some of that, as I've alluded to in the past, is a simple thing, right? As the price of currencies go up, as the price of commodities goes up, and those commodities are priced in US dollars, somebody somewhere has to buy those commodities and has to pay for them in US dollars. So they have to go and buy US dollars. 18 months ago, you could have bought oil at 20 bucks. Right now it's 100. That's 5 times. Okay, so for the same barrel of oil, you've got to pay 5 times as much. So what you would expect in this environment is, number one, if there is a shortage of dollars, what is the Fed doing about it? Recognizing that this is a temporary liquidity cash flow issue. Well, if it was the banking system, the Fed will be saying right now, well, this is a problem, right? I'm starting to see the beginnings of a major problem for the sector. So therefore, I will do what the Fed always does, is I will sell some bills into the market. Buy some bills back from the market, essentially provide a lot more cash liquidity into the banks. And as a result of that, the liquidity constraints ease. Okay, so that's normally what tends to happen. However, can you do that in the foreign exchange market? Can you recognize that you have a problem in the foreign exchange market because the price of everything, of stuff, has gone up enormously? Well, I think the answer to that is no. I don't think the Fed's watching it. I don't think the Fed understands what's going on. But within this, there's a major dislocation taking place within the trading markets of the world, right? People need dollars. Why? To pay for things. Okay, and if you need dollars to pay for things, where are you going to get them from? You're going to go and borrow them from the bank. Where are they going to get them from? They're going to either get them from other banks or they're going to go to their central bank. What's that going to do to the price of dollars? It's going to force it up. So for me, the link, there's a very clear link between liquidity and the commodity markets at the moment and the US dollar. So if you think about rate of change, because what always we're interested in as traders is not the absolute price, it's the relative price, it's the speed, it's the way that things are changing under the surface, it's the first derivative, okay? That's what traders are often interested in. So it's not the fact that the dollar is in short supply, is the dollar in more short supply since yesterday, or is it in less short supply since yesterday? Now, you and I probably aren't sitting on a bank cash desk or the Bank of International Settlements cash desk and understand this and see this and can have a fairly good idea about what's happening. The short answer is we're not. We're not in that space, okay? So what we need to do is we need to think about things from a more holistic perspective. So we will look at the charts and try and figure out if the trends are coming to an end. Because when they do, there is no doubt in my mind that today, right now, the next 2 to 3 weeks, something will change. I don't know what it will be. I can't tell you what's going to happen. Heaven's sake, maybe it's peace in Ukraine. God, they need it. But if not, right, something else will create the change. I can't tell you what it is because I'm not sure. I really don't know. But something will create the change. Now, why will that have an impact on the markets? Well, because everybody right now is on one side of the boat. For those of you who have heard me talk about the sentiment cycle in the past, you will hear me say this. The key driver for change is when everybody is on one side of the boat. Is it time for you to move to the other side of the boat? Right? Is it time for you to counter trend? Well, maybe, maybe not. I don't know. It depends on how the situation on the charts resolves itself. Okay, because that's where we're going to look to for our timing trigger. But make no mistake, right now, the whole world is super, super long of dollars. That seems counterintuitive, right? Because I just said 5 minutes ago that the world is short of dollars. That's why the price is going up. But that's not the way you think about it in chart terms, right? So when we're looking at the technical analysis, what we're really saying is that the US dollar position is substantial. When it reverses, it's going to reverse in a violent fashion. It may not be the end of any potential long-term trend, but it certainly could be the end of an intermediate trend. So macro views aside about what the reason why the dollar is going up, macro views aside, when we look at the charts, what we're looking for here is we're saying it appears to me that everybody is short of euros, everybody is short of yen, everybody is short of Swiss francs. And to some extent, in all honesty, I think that trend's only get going. Everybody appears to be starting to get short of Chinese as well too. So anyway, let's go look at some charts and get into this and see what we're doing. So when we look at the euro, right, we have to go big picture now, right? Because we're thinking strategically. And why are we doing that? Because we are at a crucial level, right? From a technical perspective, you can't make this stuff up, right? Look at the chart. Look at the years on the bottom of this chart. 2015, that's 7 years ago. You're in a situation now where we're at a critical technical juncture. Okay, so will it, won't it, right? Will the euro break lower? I don't know, is the short answer for this. Honestly, I don't know. We're on alert in case it does, but from a monthly chart, when you look at this, this is at support. Okay, and foreign exchange markets love their support and resistance. So when we break it down and we take it back a little bit and we look at the weekly chart, what's going on? Well, what's going on in the weekly chart, you can see this, right? We had the rally through 2021. The middle of 2021, it all changed. Okay, interestingly enough, everything, for the record, when you unpick this stuff, everything changed between May and August of 2021. The world literally changed there. Go and look at other markets. Go and look at key things about demand and supply in the economy. Go and look at interest rates. I don't know. There's many things. It was a critical time. I don't think anybody saw it at the time, but quite honestly, it's when inflation, I think, really began to take off. But the key thing is the world's changed then, right? And since that time, we have been in a bear market for the euro, a bull market for the US dollar for what? Almost a year. Now, then you do the analog of that and you go, now do me a favor with this, right? Here's your homework. Your homework is to go back and look at a monthly chart for the last 30 or 40 years in the euro and find out how long we were trending in one direction for a year for. Okay, for a whole year. I don't think there are very many of these. And in fact, if anything, there will be some one or two clear examples, which I suspect when we get into it, you will see that there have been some monster moves. And when it reverses at the bottom, okay, it will be a violent one. Right, okay, so this is my thesis. My working thesis here is that we're running out of steam. Okay, so when we talk about running out of steam, we can look at momentum. And is there, just having a quick look at this, I use a 28-day momentum for an indicator. Are we seeing any momentum divergence on the daily charts? I'm not getting it. Okay, I'm not getting it. And in fact, if you look at that pattern, just focus in to on the right-hand side for the chart pattern, you can see we consolidated for a couple of weeks. Well, that was interesting, but we really had to try and complete that consolidation. So what do I mean by that? We means we had to try to find out if there genuinely was a buyer down below. And though in the market, the last few days has sold off and determined that no, there is no buyer down below. Here we go again. Okay, so where? Key triggers for us, right? If you're thinking about a reversal of this trend, if you're thinking about, because right now, would you want to be short the euro along the US dollar? Well, technically you say, yeah, I really ought to. But then you go look at that monthly chart and realize you've been trending for over a year. You go look at the weekly chart and realize you've been trending forever. You go look at the daily chart and realize it's just been going down forever. You're at the end of the trend, somewhere near the end. Is it going to be here? Is it going to be 101? I don't know. Right, but what you really got to think about is that from a risk perspective, I am playing with fire. So any good news for the euro, right, will be treated very well. And again, here's some clues, right? So when you start to see the euro behave better on economic figures, on geopolitical figures, on anything that happens, and the expected reaction, your expected reaction should be, well, why didn't the euro go down then? Right? That's your moment. So if you're looking for a macro trigger, okay, that will be your moment. If you're looking for a chart-based trigger, you've got to go here, a break back above the lows on that chart, on that consolidation period we had. So in other words, a false breakout to the downside. take out Thursday's, this is a daily chart, right? So take out Thursday's high, then the market could be turning. Okay, and when it turns, I think it's worth about 3 or 4 cents, right? And it will do that quite quickly. So when we look at what's been happening recently, so just dialing in on that consolidation area, we can see here the yin and the yang, right? So I took the low of the consolidation area, I took the high of the consolidation area. You can argue whether this is right or not, and please, if you feel differently, then put something out there, right, on the chat. But what I did was then project down, so I don't feel that the market is going to go much below that 103 level. If it does, then maybe all bets are off. But for me, that's going to be quite a critical level. And I'll be watching that on the daily chart. So then when we dial down, because don't forget, volatility is quite high. So, we're looking at big figure days here, right? So it's quite difficult to run positions, if you like, for a number of days, unless you're very confident. Right now, I feel I'd be trading a shorter time frame. So let's look at the 4-hourly chart. We've gone from monthly, weekly, daily. We're into the 4-hourly now. All of a sudden, I start to see divergence. Well, that's interesting. Okay, so what does that mean? That means that potentially the market could break back again on a divergence basis, right? Could break up on a divergence basis in the euro. Okay, how do we trade it? Well, the things that I've just talked about. And you might need to go down to that 4-hourly chart to trade it. You can already see the beginnings of a short-term bottom here. They tried the downside once again on Friday. It didn't manage to push through, and we started to have a bounce back. So let's see what happens as we roll through. Okay, let's move on to Dolly Yen, because as always, we go through time like it's a knife through butter here. So I hope you're getting the hang of this, guys. And if you want any more information about the euro, then post a question and I'll try and cover it either when we get a quick break in a second, or or at the end in the questions. So please ask me anything you like. And so when we look at Dolly Yen, again, big picture, strategic. Let's go all the way back out to monthlies. Here we go again. Dolly Yen is trading at the same price it was back in 2003. That's 19 years ago. Okay, and if you go back through history, there have been a couple of times where the yen has been higher than this, but not so. When the dollar yen has been higher than this, but not many. So very clearly, we are doing something different this time. Okay, so but have a think about it. We're at the point now where the market's breaking out. We broke out of that 125 key resistance, and now we're moving on towards the 130, and then maybe something after that. I don't know, but we're on alert. Why are we on alert? Because of this. Okay, that's the monthly. Whoops. Just get this right. So here we go. This is the monthly, just dialed in a little bit. Okay, what we've done here, I'm just going to move the mic for 2 seconds. What we've done here is we're looking now at what's been happening over the course of the last couple of years. Dollar yen has been in a rally upwards since the middle of 2021. So once again, we're looking at a market that's already somewhere in the region of 15 months into its trend. So when I see this, 2 things I'm looking for here. Acceleration at this point, because it's been going on for so long. Well, we've just had that. Okay, and then exhaustion, because at this point there will be some exhaustion. Now, how far can the dollar yen move? If you look at the previous analogs back in 2013 to 2015, you can see the movement it made. It went there from 76 up to 96. That's 20 big figures. We've gone from 104 to 132. Well, percentage-wise, that's probably about the same. Okay, and then when we went from that 96 area up to the 120 area, that's about 24 big figures. So again, here we've done about 26 big figures. So percentage-wise, it's in the same zone. So when I look at that, I'm going, even just that quick analog on the monthly chart is telling me that in all likelihood, maybe we're at the end of this. And another supporting factor is this move that we're seeing now, right? We've seen the market go storming ahead for 2 months in like some kind of blow-off, aggressive, accelerating way. This is not a bear market. I'm not talking a reversal here just yet. Or am I? So when we go look at the weekly chart, we've had a number of weeks which have gone straight up. So 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. Classic Tom DeMott. Okay, we're now entering a consolidation, right? When we look at the dailies, what are we seeing within this consolidation? So we've seen the run up here, consolidation for just a few days, literally only 2 or 3 days, and then another amazing run, and then consolidation for a few days. As always, and for those of you that remember when we've looked at these things, one of the key triggers for me is to look for 2 days down. Okay, 2 days down is pretty important because sometimes it defines the beginning of the next move. What do we have here? 2 days down, bang. What do we have here? 2 days down. This is the second, only the second 2 days down. So here we are with the second 2 days down, and the market has started to recover as you'd expect on a 2-day down. So what worries me about this is this chart. Okay, this is the momentum. I quite like looking at this, right? As you can see here, new high in price, new high momentum, new high in price. Oh, hang on, no new high momentum. So for me, this is the beginning of the end, or of this particular trend. It might go on and might go up higher, but I think we're going to consolidate a bit more. And so again, what's happening on this chart, we didn't actually did we barely make a new high? We might have single printed it. We didn't do it on a closing basis. Again, we're just sort of looking like we're rolling over here with momentum, and we're rolling over here with price. So this is why the next few days are crucial. So we're going to use key resistance is the high of Thursday. That's what, about 130 and something. Okay, and obviously the all-time high, those things are key resistance. Is it the time maybe to risk a small anti-trend position? Possibly. I'll leave that up to you. But for the time being, I suspect the dollar yen is going to go into a sideways motion at best, possibly slightly lower. So early warning signs about the end of the trend in the dollar yen. Somebody's asked me about the Kiwi. Maybe I can wrap it into the Aussie dollar, which I have got. So when we look at the monthly chart of the Aussie dollar, where are we? Well, this was the big sell-off we had back in 2020 with the pandemic. That was the high. Well, when was that high? Oh, here we go, first quarter 2021. Okay, we then look at that. The Fibonacci right now is in what I call the zone, so somewhere between the 382 and the 618. I'm beginning to see monthly charts down there hitting the 50% mark, okay? And so 50% is obviously a pretty crucial support for the Aussie. I would be surprised if it broke it on the first occasion. So when we blow this chart up to look at the weeklies, you can see what's been going on. We're starting to see the cycles here, right? So cycle down, then we rally a little bit, then we go down again, then we rally a little bit, then we go down again. All the time, this appears to be getting weaker and weaker and shorter from a cycle perspective. Then we have a nice big rally, then we reverse the whole thing. Okay, so what would this do if you were a Aussie dollar investor, right? You'd look at this and go, there's nothing to see here. Oh dear, this isn't very good. Then it rallies back and you go, phew, thank God for that. Then it rallies again to a new low and you go, oh no, really? Another new low? Oh crikey. And then you breathe a sigh of relief because on the next retest of that new low we had in place, the market then rallies and you go, great, this is it. This is the new rally in the Aussie dollar. Then it takes out the previous high and you go, here we go. But then it puts a reversal in place and then completely reverses through all of the price pattern of the last 6 at least months, and then is ending up down here. So I said a few weeks ago I thought this was a neutral chart and I didn't think there was a huge amount to worry about. I'm still fairly bullish on the Aussie. In the super long term, on that monthly chart, I am. But there's still quite a bit of work to be done both on dailies and on weeklies before we're going to see this turn around. Phew. So when we look at this, okay, here's the daily chart. You can see that rejection up here. That was a pretty clear rejection. That's what we're looking for on the euro, by the way, the opposite way round. You can see, look, consolidation, move up, rejection, and look what happens. Everybody was the wrong side of the boat. And then we got into this here and people got fooled into buying. I think this was something around the unemployment rate, wasn't it? I think last week. It may have been the Thursday, Friday, or Fed meeting. Actually, it might have been the Fed meeting. And then the markets then sold off. Okay, so post-Fed, the market rallied and then just collapsed back again. So for me, right now, this doesn't trade very well. Does it trade badly? Does it trade horribly? Well, I've got in the back of my mind that monthly chart sitting there at 50%. I'm going, So do I want to be short? Absolutely. If I'm trading this short term, the trade is probably really still from the short side, short term. But again, if you look at how much we reached up to reach down for a target, we're quite close to that's about 68 even, something like that, 68.10, 68.20, something like that. To me seems like, from a price perspective, a reasonable target on a swing high, swing down, sort of swing up, swing down basis. So yeah, I'm sort of thinking that I'm a bit late to the shorting party for the Aussie, and maybe we've got to think about waiting for a better opportunity. Okay, so that's currencies. Just to recap on all of them, right? So we believe that everybody is on one side of the boat. Does that mean to say we need to run to the other? No, it doesn't. What we need to do is we need to be really conscious. This is time for a reversal. There is the opportunity for the market to reverse it in the euro, in the Swiss franc, in the British pound. Anymore, right? We saw it start to reverse in the Canadian last week, right? You've got the Aussie as well too. That looks a bit crappy now. So that looks like that's going to come down. I don't think that I'm not as positive about the Aussie as I am maybe about the euro, which is a bit weird because of where the euro trends strongly down at the moment. But I feel that trend is overextended. All I think we've done in the Aussie is wash out some longs. I don't think we've got people structurally short of the Aussie. So subsequently to that, if you think about it, that means that people were sort of on one side of the boat, but then they've come back to the middle again. Right, so it's sort of like a neutral situation. The euro, they're all on one side of the boat. The cable, they're all on one side of the boat, right? The Swiss franc, all on one side of the boat. Dolly Yen, pretty much all of them are on one side of the boat. I'm not quite sure who would be on the other side of the boat at the moment, but we're already beginning to see the signs maybe of that market topping out in the short term. Okay, so short-term trading. Okay, I hope that explains foreign exchange for you guys. Right, now, we talked about why people need dollars. Okay, so here's the case in point. They need dollars to pay for oil. When I look at this chart, this is a weekly chart. Go back and look at the monthlies, right? You guys know this trend. It's pretty obvious, right? But when I look at this, all I do every time I look at it is go, what's the problem here? Right? It's still a bull market. There's nothing to see. That 93 level for me is absolutely critical, right? We break that, all bets are off. Okay, that's it. For me, there may be something else going on and we can consolidate potentially all the way back to the 60s. We might not break the bull trend, but we could consolidate all the way back to the 60s. That's the monthly bull trend. Okay, so there's your trigger. Your trigger is that 93 level on WTI. So it'll be $2 or $3 higher on Brent, right? I don't know. Go look at the charts, guys. You can do this. So for me, we saw this week again, we had another big rally in the tail end of the week. 3 straight days up after the inventory report, 3 straight days up in oil. And there's reasons for this, right? You can argue there's geopolitical reasons, there's any number of reasons. It doesn't matter, right? To some extent, we don't care. The market trades just fine. It seems bullish. Being short of it doesn't make any sense to me whatsoever, either from a trading perspective or geopolitical perspective. While there's a war on, I'm very concerned that something silly might happen somewhere, sometime, and therefore you cannot be short of oil, especially over a weekend, right, guys? Run your risk management here, right? So make sure that it doesn't justify having a short position over a weekend to me in oil, because anything can happen over the weekend. Wars aren't fought Monday to Friday, right? Whatever's happening to Putin and Ukraine and all that other things, right? You get it. So here's something that does bother me, right? So when we look at gold, here's the thing I've got with gold, right? And the thing that bothers me more than anything else. When I look at the chart, I'm going, maybe the beginning of a top, maybe starting to turn down. Okay, when I think about what's going on in the market, the thing that really disappoints me with this, right, is there's a war on, right? Oil prices are going completely insane. Inflation is going insane, right? Interest rates have gone up. Yeah, sure, it's carnage in the bond market. It's the worst bond market environment for investors. The first 6 months, 5 months this year has been the worst for investors in living memory. I think it even beats 1994 if you're a US bond market holder, right? So that having been said, why wouldn't you go to the safe asset? Why wouldn't you go to the asset which, okay, it doesn't pay you a coupon, but at least you get capital preservation and low volatility, which is what gold tends to offer. So for me, the big shock in all of this is where's gold? Why hasn't it been rallying? Why hasn't it been making a stand? Why hasn't it been telling people invest in me because I'm the safe guy? Right? No, what we've seen the last 3 or 4 weeks is an attitude, a sentiment in gold, which has been questioned yet again. Right? So this bothers me. This is why things bother me. So we went for a retest of the high, and now we've come straight back again. If you look at this on a weekly chart, you're starting to wonder whether the bull case is still intact. So a few weeks ago, I said I was neutral on gold, and there wasn't a lot to see. Now I'm concerned. And the reason why I said I was neutral is if it stayed above 1900, we were okay. Now I'm not so sure. So at the back of my mind, right, the bear case is beginning to rise. Where would I be convinced of the bear case? Or we go back and look at that chart. There's a long way to go, guys. This thing came from 1200, and we know that marginal cost in gold is about $1,200, between 1100 and 1200. So there's your baseline. Okay, you always think about this in commodities. What's the marginal cost of product for them to stop making it, right? So gold goes back to 1200. I pretty much guarantee you we won't see Gold Rush on Discovery Channel anymore. So when you look at this, okay, you go, what's going to cause this to move here? Well, what's going to cause this to move is something exceptional, i.e. getting us below that 1730, 1750 level where gold broke up from. That's the major support. Until then, I'm sort of neutral, but right now I'm bearish neutral. Right, so in other words, how would I describe my position in gold? Oh, how about flat? Right, there's no bull case here. Maybe Ainsley has a different spin on this, but for me, looking at the weeklies, I can't get excited. And when you look at the dailies, there's very clearly this is selling rallies. It's in sell rally mode, right? You know, even after the Fed, we didn't get any performance, right? So at the moment, when I look at this, as I say, I'm going, the only support I've got is the fact that we've gone back down to the level that we broke out from. Okay. For me, no trade. Right, the S&P 500. What can we say about that? Number one, look at this thing behind me, right? The sentiment cycle. We're going to come back to this in just 2 seconds. What I want to tell you about is what we talked about late last year. So I've done a couple of these macro market overviews where I've talked about sentiment. We've gone into it in great detail in the S&P 500 or the US stock market. Is this the Minsky moment? Well, this is the point, right? I think we've already way past that in some parts of the market, and I'll explain why in a second. In the S&P 500, I think we're on some kind of journey just about, well, here we go, there, right? Well, I'm wiggling my finger. I think we've got a subtle warning. I think we've got an overt warning. I think we're in some kind of phase here. We are not in the S&P 500 at the bottom of this move. There is more coming. I don't know when, I don't know how, and we might well bounce in the meantime. But quite frankly, to me, it just looks like it's a sell rally market. However, right, when I say that, some parts of the market have absolutely thrown up. For those of you that are following the, how can I put it, the cash burning tech sector, right? That's probably a good way of putting it. So the tech companies that are start outs and are just burning out money to try and get market share, those ones have absolutely suffered. Okay, they are way beyond this point here. I think they're somewhere down here in the discouragement panic phase. I think they're near panic. I don't think they're at discouragement yet. So what's got to happen for these crazy tech stocks, right? What's got to happen is nothing. And the reason why I will explain in 2 seconds. So here's the S&P 500. We saw the bounce, but can you see this, right? We've got this sell rally, big rally, but sell rally. Didn't get back to the old highs, didn't get back up here. We retested this. For a day, we broke above it, and then we reversed quickly. That was your warning. Okay, and then the market went down. There was a rally for 3 days, sell it. There was a rally for a few days, sell it. There was another one there, post-Fed, sell it, right? And now we're getting another rally. Will this one sustain itself? Maybe it will, maybe it won't. I don't know. But right now, to me, this doesn't look like it's done. We need more time to go sideways, more time to possibly go down. That's my sense here. So let's talk about the crappy tech stocks area, right? There are some that are awful. Cathie Wood is the poster child for the awful. Why? Because a lot of the companies that she has investments in burn money while they build market share. They're revenue generators. They're just not EBITDA positive generators, right? So when we look at this, this is extraordinary. Okay, people who invested with her back in 2021, right, paid $160 a share for that ARK Innovation Fund. It's now traded last week in the mid 30s. That's an 80% loss of value. 80%. Then it bounced. Right, how much did it bounce? Well, let's look at the daily. Thursday and Friday, ARK bounced from $35 to $43. Now, I don't know about 40, let's call it 44, right? So 35 to 44 is 9 on 35. Now, my maths is a bit poor, okay, but that seems to me to be an almost 25% bounce. Like, this is not an individual stock. This is a portfolio of stocks, and they've just bounced almost 25% in 2 days. This is not a normal environment, right? This is not a potential market bottom. What I want to see is nothing happening. I want to see this stock sideways, then I'm interested. When it's sideways, then I think I can see where the bottoms are, where the potential investment support and resistance are, and I can see accumulation. What this looks to me like is panic. Okay, and all that's happened is short coverers have just bought some shares back. However, I also recognize that this is crazy cheap compared to where it was, right? 35 compared to 160. How far wrong can you go, right? Which is a really good point for a fund. So something to think about, everybody. You know, ARK investment, I always think it's a great innovation fund, right? So if you believe in the future, if you believe in tech, then you need to believe some days in Cathie Wood's story, although just you have to pick your time to clearly get involved. Now, let's look at a chart of inflation. We can see inflation moving. Do you know I was talking about sometime in 2021? That's down here, right? Pretty much as inflation moved and started to accelerate, everything else went a bit weird. I was skeptical of this acceleration. I saw it slowing down pre-Ukraine. So about November time, I saw it in my mind slowing down. Then all the problems with Ukraine started to happen. At that point in time, all bets were off. And I'm happy to admit I was wrong. Okay, but all bets were off. You cannot do any economic forecasting in the middle of a war. It is just not possible to do. And by the way, you shouldn't, because it's just going to get you into trouble from a technical perspective. So do I think that the year-on-year rate is going to continue to climb? Not really. Do I think it's going to slow down? Yes, I do. The month-on-month rate, I think it's going to slow down if it's not slowing down already. Why do I think that? Because if you just look at demand, if you look at the fact that everything's 10% more expensive, people haven't got 10% more wages, right? So there's a bit of economics here, right? It takes a bit of time, but there's a lot of people out there who are hurting. I'm sure in every jurisdiction that you guys are based in, you know what I'm talking about here. You've seen the stories. So let's have a look at this move here. This move here in 30-year government bonds, which happened from late 21. It took a long time, 6 months, for that inflationary move to have an impact on the bond market. But boy, oh boy, did it have an impact on the bond market, right in line. If you look at the seasonal pattern for US Treasuries, this is almost to the day we've done the seasonal move, for the record, right? It literally starts in November and ends in May. And here we are in May. Why does it do that? Is because often inflation is really high in the first 5 to 6 months of the year. And then the rate of increase of inflation starts to slow down in the last 6 months. So consequences. I am quite optimistic that this is somewhere near the bottom or the top of yields, the bottom of prices for bonds. Now, bear in mind what I said earlier, right? This has been carnage. You have lost somewhere between 30 and 40% of your portfolio if you invest in long-dated US Treasury bonds, i.e. beyond 20 years. You're down 40% in your portfolio in the last few months. And on top of that, you're losing money in stocks, right? So in other words, is it a good investing environment? It's a terrible one. There's nowhere to go that's safe. Find me an anti-fragile asset. Well, in fact, there is a great anti-fragile asset, and it's gold in any currency apart from US dollars, right? So gold in euros looks okay. Gold in Dolly in yen looks okay. Gold in Swiss francs looks okay. That's probably the only anti-fragile asset that's out there at the moment. Okay, I can't think of any others, because when I look around the markets, what is it? Oh, hang on, yeah, Chinese bonds. But then the currency's given way recently, so maybe not. But up till this year, Chinese bonds, up till May, were an excellent, an amazing investment. They pay a good dividend and the currency was going sideways. So regardless of what happened, they were a different part of the cycle to what's going on in the States. So when I look at this, this is just amazing, right? So let's go and look again. We'll look at our momentum indicator. So what do we see here? We see a new high in price, a new high momentum. We see an even higher high in price, high in yields, and even a higher yield here. Momentum stalls out. This is the reason. Same thing in Dolly Yen, right? So this is the reason why I'm thinking we're near the end in the bonds. When they exhibit this particular pattern, it tends to be a far more sticky than you see in some foreign exchange markets. Excuse me for a second. So, am I at this point in time getting quite bullish in price on bonds, bearish in yields? The short answer is yes, I am. Okay, so that's something to think about. Just hold on, please. And somebody needs to feed the cat. So the key message here, right, is what's going on here. The Fed put, what's happened to the Fed put? Well, I guarantee you for assets, it's gone. Okay, the Fed is completely freaked out by inflation. They know they screwed up 18 months ago or a year ago by letting the stimulus go on way too long, including the government stimulus. That fiscal monetary package, which was in place through 2021, pushed all those asset prices to record highs. But at the same time, they didn't see the inflation coming, which has finally turned up. Now they're really worried. So it's almost like they're completely at sea. They've made a huge mistake. What are you going to do when you make a huge mistake? You then go, right, we're going to sort this mistake out with another mistake. Now, what we're going to do is we're going to keep raising rates till inflation subsides. Well, I think it is already. I think people are hurting. I think people are stopping spending. I think demand is going to roll over. The Fed did nothing else, right? Didn't even bother raising rates. I think the economy is going to start to slow down in the States. However, and overseas for that matter. However, the Fed doesn't think that. So they're going to hike rates into the problem, right? So to me, this I think is quite interesting. But then when you look at what the market is pricing in, okay, the Eurodollar market is already pricing in Fed funds at 3% by December. What are they now? They're what, 75? Okay, they've got a long way to go to get to 3%. That's hiking almost 50 basis points every single meeting between here and Christmas. Okay, that's quite big. And they ruled out 75 basis point hikes last meeting, didn't they? So they're going, for them, going hard is 50. They're going to keep going hard every single month until this inflation starts to come back, right? Hopefully in time for the midterms in November. So nobody cares at the Fed around asset prices right now. They will not be your friend regardless of what happens to asset prices unless there's a massive sell-off. You could argue in some parts of the market that's happened, but in the general market, the S&P 500 breaks that 3,800 key support level, then I think maybe they'll start to notice, but it won't, even then, they won't look at it probably until we're nearer 3,000 before they think about changing the interest rates around. So consequently, it's all about liquidity, guys. While the Fed is tightening liquidity by they've stopped the bond purchases now, and they're now going to start to redeem some of the bonds that they own on the portfolio, so drain liquidity even further. Interest rates going up, liquidity coming down, US dollar going up. That's telling you it's all related, right? So if commodities continue to rise, here, and the US dollar is in even greater short supply at the same time as domestically they're tightening liquidity as well too, all hell's going to break loose. That's why I believe that somewhere along the line, somebody will intervene and hang on a second, you can't impoverish everybody who has a share portfolio, right? They will not vote for you if you do that. So there will need to be some kind of nuanced change, but I don't know when, how that's going to turn up. Hopefully in time for the election, but it's probably not going to happen before August. So we've sort of, from the equity market point of view and asset market point of view, we've sort of going to mark time, I think, through till August as we try and figure out whether the Fed really means it this time. Okay, as always, we're time poor with this. So the last thing I want to talk about is Ethereum. So Ethereum has seen a similar decline in its fortunes from a high of about 5,000. Well, that's the I thought it actually got up a little higher than that. Maybe it didn't. From a high of 4,000, 5,000 area, we're now trading down at 2,000. Okay, so again, we've lost 60% of the value of the cryptocurrency. And that's the mainstream one. I dread to think what's gone on in NFT land or in some of these minor coin lands, right? The ICOs, I cannot believe that they're doing well right now. I don't know. I'm not that well connected. Where's Shakri when you need him? But Shukri when you need him. So my thoughts here are that, is the boom in crypto over? No. Is the shine coming off it? Absolutely. Are we now in a space whereby, and we saw this week with the stablecoin incidents, are we now in a space whereby we're at major support psychologically as well as technically? So for me, crypto's got to hold this 1800 for Ethereum. It's got to hold, I don't know, the 25,000 zone for Bitcoin. If it doesn't do that, then I think we're going to see even more significant losses. And then you start to talk about losing 80% of its value as the next target point. So on crypto, if you're going to do that, you'd be looking at somewhere like $1,000 would be the final big support point for me, where it may get down to. But that's a long way from here. That means it's halving again from where it is now. So it needs to hold this level. You're looking for lines in the sand. Lines in the sand for Bitcoin, lines in the sand for Ethereum, right? Lines in the sand. What other things were we lining in the sand a little while ago? The euro, right? The gold market, the oil market's above it at the moment, right? The S&P below 3,800. I'm starting to get really concerned about it. Okay, there's a number of lines in the sand which are coming up right here, right now. We're either on it or we're close to it. That's why I just go back to this for the last 3 minutes, and I'll repeat this over again to you. So hopefully you guys have got it. I know you're really bright, so you'll caught it the first time, but just to repeat it, to sound like a broken record, which is what I want to be on this. This is the time, right? The next 3 weeks are going to prove to be whether these markets hold these major support levels. If they cannot, there will be a further decline in many of them, and the dollar will ascend further. If they can hold these points, this is a major, major, major turning point in many markets, and therefore an opportunity in many markets. Guys, does anybody have any questions? I know we've got a couple of minutes to go. Does anybody have any questions? Otherwise, we'll wrap it up, and I hope you've enjoyed the session. My quick scoot around the 7 major markets. Obviously, there's a lot more than that, but I just can only really look at those 7 with my views at the moment. So I'm seeing not many people are coming back in here. Okay, look, so just to wrap things up for you, for those of you that don't know already, I'm sure it's been announced, so I'm going to be in Singapore in a couple of weeks' time. I'm looking forward to catching up with those people who are based in Singapore. Hopefully we had a chance to catch up and spend some time together. We'll be going through some of this. We'll be going through some of the things that I'd like to talk about and teach you guys to hopefully improve your trading as well too. So this is an opportunity for you to catch up with me. I don't do this very often, and this is my first time in Singapore, I think, in almost 3 years. So thankfully, the world is a little bit easier to travel now. And whilst I'm on my way to Europe, I thought I'd swing by and spend some time with you guys. So I think we're doing the weekend of the 28th, 29th. I'm sure you guys have all the info on that. If you don't, please check out with your coaches, check out with Paul and the guys to give you some more details about when I'm around. I think I'm hovering around Wednesday evening and maybe Friday evening, possibly. Thursday evening is reserved for the premiere of Top Gun. For those of you that could recommend a cinema in there, that would be absolutely fantastic. I'm looking to see what apparently is the best movie of the year, and of course it's got amazing boys' toys in it, so I'm quite excited about that. So with that in mind, I think I'll end it here, and I'll hopefully see you guys in a couple of weeks. And I may just be in the market update in a few minutes' time, but I'm really going to be going over just in very brief terms what we talked about in this session. So as always, if you have been, thank you very much for listening, and I'll see you guys soon.